You open your banking app, $1,000 glares at you from the screen, sitting, waiting. Your instinct says to invest your money wisely, but you don't know where to start. The issue is not the amount. You rationalize that the sum is substantially lacking to make a real difference. You are correct. The reason why you feel frustrated about $1,000 has almost nothing to do with the amount. It has to do with the way money behaves when you stop using it. It has to do with inflation. It has to do with money printing presses around the world. It has to do with the fact that the US government went off the gold standard in 1971 and allowed the value of the currency to fluctuate. It has to do with the fact that John Maynard Keynes saw this process as a systematic devaluation of the middle class, with no riots or public outcry. The truth is that every dollar in your possession experiences a silent war every year. It loses ground in value because of the way inflation works in modern economies. That is why it is important to make investments with the money instead of letting it sit in a savings account. It is a bit counterintuitive, but you can take comfort in knowing that every rich person who has accumulated wealth has experienced the same feeling of inadequacy when it comes to the amount of money they are putting into investments. The famous value investor Benjamin Graham, mentor of Warren Buffett, has said that patience was more important than the amount of capital when it comes to successful investment practices. A good way to think about the $3,000 is to divide it into 3 equal parts. The first third is dedicated to ownership. When you buy into a diversified index fund, you are buying into the slow, steady, boring power of hundreds of companies growing in value and profitability each year. It is the epitome of patience and prudence. It is the most boring system there is, and it has produced the most consistent results. It is a certainty that at least one of the companies in the index will fail at some point, but that shouldn't stop you. The market is an unpredictable beast that cannot be tamed or manipulated. It has its own agenda that no economist can predict or control. There is another third of the money that is dedicated to knowledge. Daniel Kahneman, a psychologist who has spent his life studying humans, was awarded the Nobel Memorial Prize in Economic Sciences. He knew the basics of finance better than most, but he never studied economics. The most important discovery in the study of human psychology, specifically in regards to finances, is that the pain of loss is much greater than the pleasure of gain. In fact, the ratio is roughly 2-to-1. This means that people are much more likely to take irrational actions to avoid a loss than to ensure a gain. This discovery has led to the development of a branch of economics called behavioral economics. Kahneman's work with Amos Tversky has determined that humans are systematically irrational when it comes to finances and investment decisions. We are much more willing to sell an asset when it decreases in value than we are to hold on to it in the hopes that it will recover. Losses feel worse than gains of the same amount. The behavioral economist Richard Thaler expanded upon these ideas, arguing that we categorize money in ways we shouldn't. The most interesting part of his research is the fact that people see the money they save, the money they earn, and the money they invest as different. A dollar is always a dollar, but the way we perceive it is different depending on how we obtain it. That leads us to the final third of the money, which is dedicated to patience. Consider the events of 2008. Markets around the world crashed in a matter of months, losing trillions of dollars in value. The newspapers were full of articles about the market crash, and millions of people withdrew their money from the markets at the lowest possible point in frustration. People who held the investments throughout the downturn recovered the losses shortly afterwards, and then had years of steady growth on the remaining shares. The market does not punish the reckless, instead it rewards the patient. That may sound counterintuitive, but in many ways it is true. Graham said that an investor's best friend and their worst enemy was likely to be their own self. What will be the fate of your $3,000 in 10 years' time? If you invest your $1,000 in something that grows by 10% per year, then in a decade it will be roughly $2,000. That is an outstanding return on the initial investment and will provide a substantial boost to your net worth. But the truth is that there are many other ways to earn the same amount. The amount of money you invest plays a much smaller role in determining your financial success than you might expect. As mentioned earlier, if you buy the shares and hold on to them for the long term, you will almost certainly make a profit. However, if you regularly invest smaller amounts of money, you will find that your returns are much higher. This concept is sometimes referred to as dollar cost averaging. It is a much safer way to invest money, and it is extremely useful when you are dealing with unstable markets. You don't have to do anything special to make dollar cost averaging work. In fact, all you need to do is buy the same dollar amount of shares every month, regardless of the price. When the market is down, you get more shares per dollar, and when the market is up, you get fewer shares per dollar. Consistency is the key to profitable investing. The next time you hear a viral slogan that says, "Get rich quick," you will remember the slow, steady power of compounding interest and the value of patience. This is why the average middle-class salary of $30,000 or $40,000 has the potential to become substantially bigger. The Great Depression taught an entire generation to be suspicious of the markets and to keep their money in cash instead. Yet the same generation saw their fortunes grow exponentially as soon as they got back into the markets. The truth is that the markets rarely reward impatience, but they almost always punish recklessness. Think about that $1,000 in your bank account. It is not really $1,000, not anymore. It is an opportunity to understand the nature of money, an opportunity to invest in companies that will grow and adapt for generations to come. The companies that you are buying into through the index fund will not care about the amount of money that you have. They will grow and produce new products, and eventually you will be able to retire because of them. In the end, the amount of money you invest is much less important than the opportunity it provides.